Good day and welcome to yet another one of our Ransford's weekly wraps. This week we'll cover three topics as usual. The first thing is going to be the SARB rate decision. As you know, it came out at a 0.25% increase. Then we're going to have a look at the tech sector. Tesla's results came out, and we also had news that a number of big tech companies are firing staff at quite a substantial rate. And then finally, we're going to look at a buzzword out of Davos, which was the polycrisis. Let's start off with the SARB rate announcement. The SARB raised interest rates by 0.25%. Expectations had been split quite evenly between 0.25 and 0.5%, with one exception looking at 0% as the rate hike. In fact, if you have to look at the numbers, more were looking at a 0.5 versus a 0.25 rate hike. So it came a little bit below expectations if you look at it from that point of view. In terms of what the SARB is doing and what's indicative for markets going forward, I think we are approaching the end of the rate hike cycle. We are unlikely to see many more hikes from here, from either the SARB or from the Fed. The Fed is probably going to one, possibly two, but not much more than that from here, and then halt. The SARB is probably going to halt either here or maybe one more rate hike after this. And that's about it. Why? Interest rates are rising in order to fight inflation. Inflation right now does not look that heavy. In the US, inflation has come down quite nicely. Last inflation figure is looking quite good. In South Africa, inflation seems to have peaked. It's still above the 6% level. Like in the US, it's above the 2% level, but it's still coming down. And the idea would be that interest rate movements take a long time to basically have an impact on the market. Some people talk as much as 18 months. So this rate hike we're seeing right now in South Africa might only be felt fully into the market, say middle of next year. By which time it's quite likely that inflation is not as going to be a bigger problem as it is right now. So I think we are coming to the end of the rate hike cycle when they're going to start looking at the rate cuts. Maybe end of the year if interest rates, inflation in the US falls a bit more. Speaking of which, there was a bit of bad news around that. Apparently, the cracking cost—that's the cost of making a barrel of oil into some gasoline and other products. Almost tripled at the end of January because of weather events, but that seems to be a bit of a temporary measure, and I think that might just disappear over time. Overall, the trends are looking in one direction, that's towards a lower inflation rate, and I think that's going to translate into, like I said, lower interest rates, and the market probably is going to be liking that going forward. The next thing we talk about is the tech sector. We are looking at a tech sector that's basically under a bit of pressure at the moment. We are seeing massive amounts of layoffs happening. Microsoft, Google, Facebook. We obviously started by Twitter to a certain extent, and I think the total number at the moment comes to about 150,000 people over the period of about 6 months or so. So 150,000 people, 6 months. Look, roughly it's just under 10% or so of like the workforces, like between 5 and 10% is the kind of numbers most of these companies are looking for to reduce their workforces. But you must understand, this comes after a couple of years of incredible hiring. Looking at Google's number or Alphabet's number in terms of people, they've went up multiple times in the last 5 years. They have many more people working there now than they did 5 years ago. Facebook has almost doubled its workforce, or better, doubled its workforce over the last 3.5 years or so. And if you think back 3.5 years, 5 years ago, Google was still pretty much Google. Facebook pretty much operated like it did with Instagram and everything else. There's no real reason you'd have seen them for doubling their workforce or doing multiple increases in workforce size over that period of time. It doesn't make sense from a pure product point of view. There is a belief that because of the pandemic and because of the number of people that were at home and people that moved on to an online kind of life because they couldn't do anything else in real life, these tech companies misunderstood the trajectory of growth on the online space, and they thought that the kind of spike they saw in the pandemic was going to have a longer lasting effect, and that's one of the reasons we've seen the pullback. I also suspect what's happened is a lot of the people that were hired were not really useful to the company. I mean, there's plenty of videos out there on places like TikTok, etc., that show a day in the life of a Google worker or a Facebook worker and so on. And generally, these people are getting to the office, having a cup of coffee, going and getting massages, and eating weird foods at the restaurants, and doing maybe an hour or two of work in the day, and then going out at night and partying. They don't really seem to be basically adding much value to the companies that they were in. Not to say that they want intelligent and they want capable people. To a certain extent, this might actually be a positive going forward, because what's going to happen here is you're going to be seeing a freeing up of a lot of brains from effectively useless or sort of non-productive work, and those brains could effectively do a lot of things out in the real world. Maybe not the perks and some of the money initially that they were earning at these tech companies, but longer term probably going to be a positive for the world, maybe even for them. So the tech companies are under pressure. And speaking of tech companies, we saw Tesla release results, and the Tesla results that came out were reasonably good. Talks about getting up to maybe 2 million cars this year. Increases in terms of volumes because of drop in prices. Tesla has been dropping prices recently, etc., etc. And the stock reacted positively and jumped up on the news. Now, I don't really think that's the right way to think about things. If Tesla is only a car company, Tesla is not worth what it's currently priced at. It's worth a fraction of that, maybe a fraction of that. Tesla's only value at this level has nothing to do with whether or not it's a car company able to build 1, 2, 5 million cars or whatever. Tesla's value, quite frankly, is all in its AI systems, its AI technology. Compare Tesla, for instance, to GM. Tesla's P ratio is like 7 times higher. Tesla's basically volume of cars is 1/5 of what GM's is. Tesla basically is worth, I think 9 times or 8 times as much as GM. So you make far less cars, like 20% of the cars. Your P ratio is just totally screwed. That's crazy. And you basically have a price that's 9 times higher. Doesn't make sense. Because GM is a car company and it's valued like a car company. Tesla is not valued like a car company. And if you want to be buying Tesla at this current price, the only way you need to evaluate it is as a tech company, and tech in one particular area. Now, it has a couple of things that it does reasonably well. It does the cars, but it also does the batteries and all those things. Those things are nice. They're kind of like nice little kind of add-ons. But to get the kind of valuation of Tesla, you can't value it as a battery company. You can't value it as a car company. You've got to value it as a tech company, and the tech is valued at is full self-driving. And why is this important? Well, what you must understand is, despite all the wonderful things we see computers do nowadays, all the technology you have, all the AI stuff and so on, the one thing computers really can't do is something a 5-year-old or even a 2-year-old can do. That's see the world, understand what's happening in the world, and act in it. You can tell a 2-year-old to go and pick up some red blocks and bring it back to you, and she will be able to do that quite easily. There's no machine in the world that can understand what that means, how to do that, what the world means on a generalized basis. Oh yeah, you can take a machine that can do a red block thing, but the general scope of the way a 2-year-old interacts in the world, moving things about, navigating the world, walking around, not bumping into things all the time, those are things that are beyond the scope of any computer program, any machine. Full self-driving, what it does, it would build a model of the world in the computer's inverted commas brain. That model of the world can be used by the computer to understand what's happening in the world and to act in it. Just like how we do. We don't see the entire world. We build a model of the world in our brain and we act in that model, and therefore that's how we navigate the world. We know where things are based on that model. And obviously we update with our eyes and so on, but that model in the brain is what kind of like navigates the world for us. The same thing is being done by Tesla right now. Now, if it's able to achieve that, cars are just a part of what it can do. The whole car market gets revamped. But not just the car market, and things like property and so on, because of transport being revamped. But if a machine can perceive the world and act in it, why can't it wash some dishes instead of just driving around the road? Why can't it pick some apples and basically, garden? Why can't it build stuff? Whatever. Once full self-driving occurs, what it becomes is the ability of machines to recognize what's happening in the world, to build an accurate model of that world and act in that world. That is something that I think is worth a lot more than any full self-driving, car would be. And if that is something that Tesla can do, then we're talking about a company that's probably 100 times undervalued right now, not massively overvalued. So that's the binary. Without this technology, it's worth less than a tenth of what it is right now. With this technology, it may be worth many more times than a tenth, maybe even 100 times what it is right now. So this technology, whether or not it can and cannot do it, is what defines what Tesla's valuation is. Not whether or not it can produce 1 million, 2 million, 3 million cars. It does nothing. It makes no difference. In reality, it doesn't matter if it basically has volumes going up or down. It doesn't matter if there's something happening with batteries or not, unless the battery technology is incredible. Okay, and it has to be really incredible to do this, because the current batteries companies of the world are not all together being valued at what Tesla is being valued at the moment. So in reality, what Tesla's valuation rests on entirely virtually is that AI full self-driving technology, and if they can achieve it, the world looks very different than it does right now. And that comes to my last little bit. It's what's called the polycrisis. It's a new buzzword that's come out of Davos that I thought maybe it might be worth looking into. What a polycrisis is, it's a multiple crisis at the same time in different areas that are basically reinforcing each other, causing problems that one crisis alone would not have caused. Now, to a certain extent, we can say that we are in a polycrisis moment. We've seen, for instance, the war in the Ukraine. We've seen, for instance, the pandemic, and there's obviously the ongoing problem of global warming. There's also been political unrest, etc., that we've seen come through. And the idea is that we're living in a time of polycrises where what's happening in climate is being reinforcing what's happening in the war, and what's happening in, for instance, with regards to demographic change and so on and so on. And they're causing a bigger and bigger snowball effect. Now, do I think this is true? Possibly. It's quite possibly that we are seeing some kind of interweaving, reinforcing drivers causing these troubles around the world. What could they be? Well, one thing that you look at, of course, is climate change. The climate is changing, human or not. Blocking the debate, that probably is human. Been causing this climate change happening. So people are causing climate change because of global warming, because of carbon release and so on. But you can't deny that it is happening, that we are seeing some of the hottest days and some of the coldest days, in record. Right now, we had one of the warmest winters in record from the European Union. And in Siberia, right next to the Europe, we had some of the coldest ever temperatures recorded. So climate change is happening. Climate change, of course, affects things like food production. It affects things like the mobility of people. People are moving from one area to another to avoid the negative effects of climate change, which causes unrest, which causes instability, which causes the rise of things like populism. For instance, we saw in Austria to be blunt about it, the birthplace of Hitler. The rise of a far-right party, that's the largest party. They probably won't get power, but they're the largest party. They're a minority party, but they're the largest party. The coalition will invite them in, but it's still rising up. We saw, of course, what's happened in Hungary. We saw sort of pushback, in terms of like migration in places like Greece, and the UK, for instance, was primarily driven by that in terms of the Brexit strategy. So that's one effect. Then we also have, for instance, the war. The war might have been caused by climate change as well. There's obviously issues around demographics in Russia and that part of the world that might also be motivating people to do certain things. And the fact that we have the war affects production of food, affects production of fertilizer, that feeds back to some of the crops and some of the stuff that's been negatively affected already by climate change. So you can see how you have this interwoven kind of situation happening right now. And the question then arises, what do you do in such an environment? Well, what you need to do is be diversified. Because you have a polycrisis, you have many different drivers of a negative outcome. You don't know where the negative outcome is really going to be the strongest, where basically you might find an area that, for whatever reason, is protected by the worst of it. And the only way to actually, benefit from that knowledge is the fact that you want to basically have a diversified portfolio. If you know for a fact that you don't know exactly what things are going to happen, what you do is you diversify. You have a large spread of assets and investments. And I think that's one of the things that people are going to be doing going forward for the polycrisis. The next thing is you need to have some kind of backup to what you basically are using currently. If there's a problem in one area, you want to have a backup to that. In terms of, for instance, in South Africa, you want to maybe have a backup to your South African accounts in terms of your investments. Having offshore investments, having investments directly in offshore companies, offshore banks, etc., is probably going to give you a better impact on your investment than having everything concentrated in one, jurisdiction, one platform, and so on. So I think that diversification is, of course, an issue. Next is stability. If you're having these crises happening all the time, you can't just be looking at return. You've got to be looking at stability. Why? Because if you're in the wrong jurisdiction, even though you've made some right decisions, the one factor being in the wrong jurisdiction means that you've lost, much of your assets. You could have done whatever the other actual investment, but because your custody is in the wrong area, you are in trouble. I think that's a problem that could be getting worse going forward. We've seen, for instance, that with regards to, some of these emerging market countries that have been really popular in the investor landscape, for instance, Sri Lanka, like we mentioned before, or Ghana, there's been a real strong pushback because of what's happened regarding, unrest in that country. And what that pushback has done, and what that thing has done, is actually made any investment in the country, even if the investment itself might be reasonable, vulnerable. So when you have this uncertainty, stability, safety is going to be at a premium. If there was none of this risk, you could basically go anywhere in the world that had the best return. With this risk, you have to go for the safest place, and then, even if it's the worst return, work with that. And then finally, in terms of what you should be doing, is looking for those particular sectors that are going to benefit from this. Look for growth. What would that be? Well, commodities in the right jurisdictions, the more stable jurisdictions, are probably going to have a benefit of those commodities in a less stable jurisdiction. If something is basically more stable, there'll be an advantage for being in there, having access there. Then something that's less stable, because even if you have a requirement for certain commodities, and you have one product that's basically right at your feet and the other one that you're going to go fetch, even if the one that your feet is a little more expensive, the inconvenience might be worth the actual effort. So look for growth, look for things that are going to benefit from the idea of instability, especially in places like the emerging markets, and look for diversification, not being trapped in one basket. Okay, that's it for today, and thanks for having me over. Look forward to seeing you guys again next week.